Ted, welcome to the show.
Hey, Brandon, how are you?
I'm doing great. Thanks for joining me today. Let's dive into it. Can you start by introducing yourself a little bit and tell us, the story behind Maverick and what you all do at Maverick?
Absolutely. Thanks for taking the time to speak with me today, Brandon. I appreciate you having a space for me. I am co-founder of Maverick Real Estate Partners. I have one partner, David Aviram. We are 50-50 partners. We started this business about 2010 on the heels of the global financial crisis. We buy non-performing loans secured by real estate in New York City. So we're very targeted in what we're investing in, and we're very targeted in where we are investing. In other words, where the collateral is located for the loans that we are buying. We're buying those loans with the goal of being repaid. So these are loans that are not performing that we're acquiring from both private lenders and banks.
And what were you doing before you started Maverick? How did you decide to get into this space?
It's a great question. My background is quite different than David's. Dave and I met in 2004 at Columbia Business School, where we became friends, and both were sort of cut from the same entrepreneurial cloth, always wanted to start our own business. But before we actually started Maverick in 2010, I worked in the real estate development construction business. So I was managing large projects for developers, mostly here in New York City, building ground up projects, condominiums. I did a hotel project in Miami Beach. And, as the global financial crisis hit in 2008, there wasn't a tremendous opportunity to do real estate development. There was no credit available. I was spending a lot of time underwriting deals that were never going to be built. And Dave reached out to me and said, "Hey, Ted, now's the time. Let's take the jump that we've always wanted to. There's got to be opportunity out there. We'll figure it out." Dave, post-business school, had been working at Eastdil Secured, doing real estate investment sales and investment banking. And so he was really building some depth around his underwriting skills and selling large buildings here in the city. My experience was much more tailored towards projects, specific projects on buildings, and so much more sort of directly asset-based. So in 2010, I think it was February, we had left our respective jobs and we got some office space and had to figure out what we wanted to do. And we wanted to find out first where the opportunity was, which was unclear. When you walked around the city in 2010, we're now 2 years into the global financial crisis, and there are broken projects everywhere. It's obvious that there's problems all over the place. And so we figured that the problems had to be with the banks, with the lenders. And so we started just cold calling lenders. And what we heard initially was, we don't have any troubled loans. We don't have any problems. And it didn't make any sense to us because there were broken projects everywhere. And so we said to ourselves, there's got to be another way to figure out where the broken projects are. And that sort of sent us on the hunt, to sort of build out some data. And we started just simply forming lists of banks, lists of private lenders. We started finding some publicly available evidence of distress, lists of list pendants. And we got lucky in the first year and got a few inroads at banks who wanted us to come in and take a look at their loans that were troubled. We were a fundless sponsor at the time. Neither Dave or I come from a lot of money. We didn't have capital. So we were also courting private equity funds at the same time, trying to pair together the deals with the money. So we're telling the banks that we have money. We're telling the private equity funds that we have deals, and we're hustling to try to put those two together and make things happen. And in the first year, we got our first deal done. It was a $6 million land loan secured by property in Williamsburg, Brooklyn. And it was a great opportunity for us because we found a private equity fund to work with us who generously funded our portion of the capital to start and then gave us time to raise capital from friends and family thereafter, which allowed us to focus on doing what was really important, which was deep due diligence on the investment. What was great about that opportunity was that we got repaid in about 4 months. We made some money and we were in business. We had a proven business model. We made that money by paying nearly par for the loan and then accruing default interest at a very high rate. It was a 24% default rate loan. And the borrower paid us back through another party very quickly, generating a significant amount of income for us, which really allowed us to catch our breath. We'd been in business about a year. We'd identified a lot of opportunities. We'd come close on a few. But that was really our first opportunity that we closed and made some money. Along the way, my wife was expecting our first child, my son, who's now 12 years old. So I had a window of time to be successful. Otherwise, I was going to be the nanny. And after we closed that first deal, that's exactly what I became for 3 months. And that was just a matter of having, enough means to support ourselves. Fortunately, both Dave and I, our wives are intelligent and well-educated people with great jobs, and they were able to support us during the early days of Maverick. And so, we got paid off, made some money. I hired a nanny, and we got back to work. Not that Dave wasn't working during those time periods, and Dave's always been, a great partner to work with, and that he's, sort of very supportive and understanding about the complications of life and sort of, growing this business together. We've seen our share. But what was exciting, about that is that now we had some money. There was still distress. We knew what a deal looked like. We knew who was interested in doing some of these deals, and we set about finding more. About 4 months later, we closed our next opportunity, which was a hotel under construction on the Lower East Side of Manhattan. And what was really fascinating about that deal was that sandwiched in the middle of the capital stack was a mechanics lien. Mechanics lien, if you're not aware, is a claim by a contractor for work that they performed on the property and weren't paid. And with a construction loan that's funded in tranches, if a mechanics lien is filed by a contractor or other groups that are allowed to file mechanics liens, architects, engineers, and in some cases brokers, it has its place in line. In other words, it sits right after the last funded tranche of the loan or the last distribution of loan. And then the bank proceeded to distribute more funds for additional advance requests from the contractor. So that mechanics lien was sitting there sandwiched in the middle of the capital stack. And when we bought the loan, we assumed we'd have to pay in full. It was about $1 million. And it was well secured. We paid just about par for the loan at the time. We thought the property was worth nearly $20 million. I think it was about a $12 or $13 million acquisition. And we assumed we'd have to pay it off in full. But what was more interesting to us than anything was that the mechanics lien had been recorded on that property for over 12 months prior to the loan actually being in distress. We'd found the opportunity just from cold calling a bank. It's a bank that's no longer around today, closed during the GFC. And they sort of let us in to sort of get our opinion of value. We thought to ourselves, well, if this was on the property for 12 months before, perhaps there's other situations like this. How do we find all of the mechanics liens on all of the properties in the city of New York? And how do we use that as a lead list to identify new opportunities?
That's fascinating. We're going to come back to some of the advanced kind of data and analytics tools that you all have been using since the beginning. Before we go there, you started the business in 2010 with you and David. How big are you today? Kind of what are the metrics that you share publicly about Maverick just to help our audience orient themselves in terms of size and scale?
Yeah, sure. I'll give you a little more history on it too. For the first 5 years, it just remained Dave and I, just the two of us in an office, just hustling, working away. Today, we're 20 people total and looking to hire a few more. We haven't closed on opportunities lately, although we've been seeing a lot. We're having a lot of fun. We've been back in the office for about 2 years full time. Although I'll tell you that Dave actually never left. He was in here while I was, at home hustling from there.
That's awesome. That's great. And 100% New York focus, correct? New York City focus, I should say.
100% New York focused, New York City focused. We do have some ability, some flexibility within our funds to go a little further afield. The truth is that we've found that there are other reasons to stay here and stay more focused in New York City.
Great. So let's talk about the current debt markets or credit markets. You mentioned you started the company in 2010 when things looked, at least based on your description and my recollection, a lot like they do today. Maybe I'm off by a few quarters, but not entirely dissimilar. Where do you think we are in this kind of market cycle, the distress cycle specifically? And, how are you focusing your energy at Maverick to find, opportunities in the current market?
Yeah, I think it's a great question. I do think today's market is quite different, than 2010. I think there are some things that are similar. But obviously, one of the big differences is the rising interest rates, right, which are putting really significant stress on the situation. If you look back at the GFC, the Fed was able to drop rates, which helped borrowers out significantly to repay loans and for investments to happen. In terms of where we sit in the cycle today, I think it's very early innings. We have not closed on a new investment opportunity since November of last year. That's very rare for Maverick. We historically are closing 3 to 4 deals a month and have been doing that pretty regularly for 5 or 6 years. So for things to be that frozen is relatively remarkable. We published some data recently on the lending market, on the credit market in New York City, and it's basically ground to a halt. What used to be, leading up before the rate hike started, to 2,500 loans being originated per quarter in New York City is now down to 1,000 per or less. So we're below 50% in terms of lending volume in New York City, which is unbelievable. And that's both banks and private lenders. And so there's been really significant decrease in the amount of credit available, and there's just no transactions happening right now. So, the question as to where we're seeing deals, where, things can be structured, and it's really different than anything we've seen before. We're sort of thinking about them in 2 buckets. We're thinking about them as sort of consensual deals and then non-consensual deals. Non-consensual deals would be your typical debt acquisition or non-performing loan acquisition, which is Maverick's bread and butter. It's what we've been doing for, 13 years. When we talk about consensual deals, we're talking about originations, right? The opportunity to originate mezzanine debt on properties where there's going to need to be some gaps filled because the property is no longer worth what it was, and the borrower is going to need some additional capital. That's interesting. We're also seeing opportunity within the private lender space to provide some rescue capital. So private lenders, as you well know, have been generating outsized returns, often by using leverage for the past 10 plus years. Those warehouse line providers, which are generally banks, are putting pressure on the private lenders to repay those lines where there's problems. And we've actually had some inbounds from private lenders saying, "Hey, Maverick, we've sold you deals before. Would you take a look at this? Would you consider taking on the A note or our warehouse line in this position?" Those warehouse lines generally were 50 to 60% of, what those lenders thought their loan, LTVs were. And so they were very safe positions. We've seen situations today where we don't even think those are at a discount enough to the collateral to make sense. But we do like the idea of coming in to provide some rescue capital from a protected position where we can generate an outsized return. Another place where we've seen opportunity is when we have banks who want to sell loans, ask us for, what we think it might be worth. We take a look. We give them an offer that they're not sort of interested in. But perhaps we've transacted with them before, or perhaps they know we're a credible counterparty and sort of the foremost debt buyers in New York City. We're talking to a couple of banks about buying loans where we'll invest a nominal amount of money, and then that money will be subject to some sort of waterfall. So an example of that would be a $30 million loan, which maybe we wanted to buy it for, say, $20 million or something like that. But the bank wasn't willing to sell or take the hit on their balance sheet at this time. What we're talking about doing is investing, say, a nominal amount relative to the deal, say $5 million, in some sort of preferred capital treatment where we get our money back first. We get some sort of preference or preferred return on top of that capital. And then there's some sort of split or series of splits over a bunch of different hurdles. That way we're aligned with the bank. We're getting our money out, and we're sort of all trying to do the best that we can. Should things go in a really positive direction for the real estate markets, the bank can do really well. Also, the banks recognize that we're uniquely tailored to do this type of work, and we're happy to do it. We do like to have some skin in the game, and we do want to invest our funds as well. But that's a structure that I can imagine happening more. So at the present, we're sort of seeing these consensual deals where multiple parties are agreeing about some structure or a way of putting something together to solve a problem. I think, as banks and private lenders start to take their medicine and start to mark their positions, and, there's a number of catalysts that may cause that to happen, that'll eventually turn into, non-performing loan sales. And we saw this when we started our business in 2010. The global financial crisis started in 2008. And 2 years later, when we started our business, there were still a tremendous amount of broken deals available. And those went on from when we started in 2010 through into 2013. So there were several years of runway after that. I can imagine a scenario in the present market that the non-performing loan market is much bigger, simply because of this interest rate problem. And I think when Dave and I talk about it or think about it, we see this as sort of a once in a career opportunity, the present environment. And we're generally excited about that because for our core business of buying non-performing loans, it's going to just be tons of supply.
So when you look at, I think that's really interesting, and in many regards, New York is the epicenter of the world's financial markets and real estate, and we see these headlines about New York-based developers distressed. Yet, what you shared with us just now is that the market's still stuck, and interest rates are one of the reasons why we're at this bid-ask spread. But what are you looking at as early indicators to figure out kind of what's going to unstick the market? Is it just a function of time and everything working through the process? Or are there other things that might be happening kind of at ground level that are going to help us get unstuck so the banks start to, the borrowers in the bank start to have these productive discussions and transactions happen?
Yeah, it's interesting. So, the system has to move, right? It can't stay frozen. It can't stay stuck. It just doesn't work. It won't be a system. And there will be sort of much bigger failures and problems in the economy. So the question is, what are the catalysts that are going to get it moving again? I think there's a few different things that we see, though we can't be for sure what they will be. One is the bank regulators, right? We've seen, 3 or 4 banks fail already in this cycle. And I believe we're talking about, SVB, Signature, and First Republic, and collectively, they're 2, 3, and 4 of the largest bank failures ever in this country. And I think that, a lot of people turned and said, hey, regulators, like, why didn't you catch this? Why didn't you see this? Well, I see that as emboldening the regulators, or perhaps giving their voice a little more volume in the system. And I think that the regulators are going to put pressure, on banks to face reality and remark some of their loan positions, which should then encourage some sales, right? Because once the positions are marked down, the value destruction sort of recognized, it's best off for the bank to get liquid in order to, again, go about their business of making loans. So I think regulators are a big piece on the banking side. On the private lending side, I alluded to it before with the potential exits for private lenders, but I think it's they're leverage providers. The leverage providers aren't going to hang around forever. The leverage providers are also often banks. We're going to have their own regulators putting pressure on them. And I think them pushing the private lenders to, resolve their loans or sell their loans is going to force, some activity. And I think those two things could be some primary drivers. Another, huge driver could be the Signature loan portfolio, which is now a portfolio of loans owned by the FDIC. But the commercial real estate loan portfolio of Signatures is $34 billion. The FDIC has indicated that they're planning to sell it. They've hired Newmark to do so. This will be the biggest loan sale, commercial real estate ever. Of the $34 billion, $24 billion or $23 billion or so is based in New York City. That's a tremendous amount of loans that will sell. 11 billion of those loans are rent stabilized properties. They're going to be selling these properties over the next few months, or these loans rather. And they're going to be competitively bid by very sophisticated groups. That ought to serve as a mechanism to reset pricing. And I got to imagine that as a bank or a private lender facing a regulator or an investor or a warehouse line provider, when you point to those sales and ensuing transactions, that it's going to be hard not to mark down your positions and acknowledge what they are actually worth. So I think that the sale of that loan portfolio could have a really big, effect on the market. We didn't talk about it before, but as much as credit, is frozen in New York. I mean, the absence of one of the biggest lenders, Signature Bank, is a huge piece of that, right? These were one of the go-to lenders in New York City. It's no longer there. It's gone. And so I think some of those things could force, could provide some people to get in motion.
So if you had your crystal ball and we're recording this on June 20th of 2023, when do you think we will start to see transactions on that Signature Bank portfolio?
That's a great question. We've had conversations with the brokers recently. We think Maverick has a place involving this transaction. We think we bring really significant data expertise and foreclosure expertise, underwriting expertise to the situation. So we've been sort of keeping tabs on it. Every few weeks we hear, oh, it's coming out in a few weeks. Every few weeks it's coming out in a few weeks. And so far it hasn't come out. So I think we'll see it when the FDIC says to put it out on the market. I think everybody's eager to see it from the buying side, but also from the brokerage side. And so I think they recently just sold the VC portfolio, which was about $600 million, I believe. It's not something we would look at, so I didn't really track it. There's a handful more stuff to sell, $34 billion plus dollars worth of loans, and we're being told later this summer. It's funny, if you ask around in the market, everyone has a real answer for you. Oh, it's coming out in 2 weeks. But I'm not sure that that's accurate. I think we'll know when we know. I'm not gonna predict like everybody else.
That's fair. That's fair. You mentioned it's part of the portfolio is rent regulated. Is that something that you all will look at, or how does that play out from an underwriting perspective relative to the non-rent regulated components of the portfolio?
Yeah, it's a great question. $11 billion of rent stabilized apartment buildings, in New York City. The scale of that is absolutely tremendous. These are places, where people live. And as we understand it, that is a big part of the concern, that the quality of housing, the availability of housing will be disrupted for these people. And, the FDIC has a mandate not just to achieve the highest price, but also to preserve housing. And in this particular instance, those things are a little bit opposed. So I think there's tremendous challenge in selling this because of the dollars needed. Right, $11 billion. There's only so many groups that can close on a transaction like that, even with FDIC financing on both sides, both at the portfolio side as well as at the investors level. We've heard stories or rumors that there's a series of nonprofits that want to be involved, or that they're trying to involve, that could be helpful to make sure that that the tenants are well protected. I think there's some good sense in all of that. How it results in a transaction is very complex, right? And how say an investor is supposed to maximize returns as a fiduciary to their LPs is at the same time supposed to be concerned on the other side. Meanwhile, as a lender, you don't own the property, right? You're the lender. The property owner owns the property, but these properties, they have significant capex that's needed, right? It's been delayed. Money's not being put in. There's a lot of uncertainty around these properties and these loans today. So I'm sure that some owners are not doing a good job of taking care of those properties as is. And I would bet that the longer this goes, the more of those loans go into default, which is a more complicated situation to resolve. So, I think, there's a lot of, work to do there. You asked me about, underwriting this stuff. I think, the rent stabilized stuff alone is difficult. We'll see what the data tape looks like. That's not been put out, by the broker or anybody else at present for the rent stabilized or any of the commercial real estate loans. We've built our own here at Maverick, just using our data, and have started building our own models and analyzing the portfolio, with the idea being that we'll be able to swap in, their data tape or even just attach it to our data tape, because we believe we'll have certain data points that are superior. But you're really looking at what those rents look like. The growth is capped. The expenses are climbing significantly, right? There's inflationary pressure there. Things like fuel, insurance is climbing, and we'll get to some sort of valuation on the collateral, and then you have to assume, some sort of default rate on those loans, them going bad, and run them through, what we do, at least when we underwrite, is run them through a probability weighted scenario analysis, where Some are getting resolved quickly. Some are going sort of medium, and some are going long, and get to some sort of return profile that is worth all the risk that's involved there. So I don't know if I fully answered your question, but it's complicated, and there's a lot of information missing still.
And the last question on the signature bank topic, a transaction of that size and scale, would that typically transact to a single buyer of the whole portfolio, or is there a possibility that it'll get divided up into multiple buyers depending on, the asset class or the profile of the underlying security?
Yeah, I think it's a great question. We'll see how they come out with it when they sell it. What we've heard is that they're going to split it up into chunks. A simple way of doing that would be free market, rent stabilized. Other ways of doing it would be sort of loan sizes and asset types, right? You could do split up the retail from, say, the multifamily, from the rent stabilized, et cetera. And so our understanding is that they're going to split it up in some sort of buckets. And then you'll be able to bid, in parts on it and in whole. And I think that, they're going to try to sell it for as much money as they can. I think there's a complication around the rent stabilized stuff that they're going to factor in some other aspects of the buyer's profile and the buyer's team. And I think that it all could go to one buyer, provided that the FDIC is providing really significant financing. We understand that they're sort of willing to finance both the overall portfolio acquisition as well as the investment piece by the actual investor. And so that sort of makes it a little more possible for it to go to one group. But we'll see. I think I until they break it up, I think it's hard to predict how it sells. I mean, there's only a handful of groups that can actually really bid on loan portfolios that are this large. We are obviously interested, but as I mentioned, my 6 fund is $317 million. I've got about $150 million in dry powder. That doesn't really move the needle on a $34 billion loan portfolio. So we're a participant. We think we provide information advantage. We think we have execution advantage just by our sheer experience. But this is the Apollos, the Blackstones, the Starwoods of the world who are going to play in this. I think ultimately, even if it did go to one group, it would be split up subsequently along the way, or things would be sold off in different parts and pieces.
So you mentioned the information advantage. Let's talk a little bit about kind of how you use analytics and data to help inform, the way that you identify and underwrite investments. I know that, you've highlighted to me in the past that it started off a long, long time ago and very manually, but maybe kind of tell us the story of how this all began and, the evolution of your kind of data-driven investment approach.
I mean, we started going there a little bit, in the beginning of the conversation around this mechanics lien on the second deal we did. And so I'm just going to go back to that for a minute. We really saw this mechanics lien as a potential lead generation opportunity. And so we asked ourselves, where can we find all the mechanics liens recorded in New York City? This is 2010, and today it's very different. But back then, the only way to get a list of mechanics liens was to go down to the county clerk's office underneath the courthouse or in the basement of the courthouse, and they have a green screen computer. And you could sort the list, and then you could poke through them one at a time, one per page, and there was a print screen button. And you'd hit that print screen button, and it would go to the printer and print out. It was a shame because it was a real waste of paper, too. One page, one mechanics lien, about this much text, not very much information. And a block and lot, dollar amount, the lienor. And we sat down there for weeks on end, printing out every single one over $100,000 in New York City. We did Manhattan first, and then we worked on Brooklyn and Queens, and we kind of went from there. But every time we finished, a borough, we would scan all of these one-pagers and send them to a firm that was based in India that would actually enter them into a spreadsheet. And that produced our first sort of database of leads, right? We took this mechanics lien list and went through one property at a time, looked on the public record to figure out who was the lender on the property. And we said, hey, Mr. and Mrs. Lender, we see there's a mechanics lien filed on this property. We're interested in buying your loan. And that received mixed reviews. Sometimes they told us to go away. Sometimes they were like, thank you, that's helpful information we didn't know. And sometimes they say, yeah, no, that's not a problem. I'm aware of it. But hey, why don't you check out this other opportunity that we have for sale? And so through that sort of process, we had a means of reaching out to people and talking to them about something real, not saying, hey, what do you have for sale that's distressed? Nobody wants to air their dirty laundry. And we learned that really early on. Fast forward to today, and we've now built like a really sophisticated data-driven sourcing machine. We call it affectionately in-house the deal machine. It's got a web-based interface that you can sort of query the data, but the data is really comprised of many different other publicly available data sources. And it really comes down to three categories. There's court filings, right, which include foreclosure, general litigation, bankruptcy filings. Then you have title records. These are about properties, which include deeds, loans, any other types of encumbrances. And then you have what we call, agency data, which are really like property taxes, water and sewer bills, DOB permits, rent regulation information, corporate filings. And what we've done with all these different databases is to connect them. But what's interesting about that, and this is why this is so hard, is that this data is filthy from a data perspective. First of all, it's all manually entered by clerks, by humans who make errors, right? Second, they're all using different systems, right? And they're some of them are last name comma first name, last name comma first name, for example. Others of them have the word junior or Roman numeral 3 after the name. Sometimes there's just a spelling error. And so the first thing you have to do with any database that you want to ingest is to clean it. And you've got to clean it in a way that makes it the same format as the others. So we get some files, like the New York State court data comes in one single text file. You've got to take that single text file and put it into some sort of structured database so that you can actually use the information, right? And so what you do, once you have all these databases clean, and we've been building this for 10 years, so it's a work in progress, but what we have now works really well. You're connecting these different databases, and you're connecting them through like fields. Those could be a person's name, a property address, a building identification number, which is the system that the DOB uses, a phone number, or many other things. And what you end up with is basically this very complicated three-dimensional database that you can query it looking for what we refer to as instances or evidence of distress. And with that, my team has a lead list of warm leads to reach out to banks and private lenders on a regular basis and seek, opportunity or situations where those lenders might want to sell their loans.
So today, just to clarify for kind of all of us who like clean data out there, this is coming in single. You mentioned the foreclosure, the title record, and the agency data is coming. Each one of those categories comes from a single source of truth, or within those categories, there's multiple sources of truth that still need to be cleansed before they get married across the different types of data sets that you're aggregating.
All come from different groups, right? And it depends. Some of this data is coming at the federal level, right? Some of it's coming at the state, some of it's coming at the county, and some of it's coming at the city level, right? And so if I'm collecting county data, I've got to go to each county and pull that data. That will come in different forms due to different customs that those counties have developed. And this is all just New York City, right? And New York, since the Bloomberg eras, has made an amazing effort to develop their data and to be transparent with their data. But there's still a lot of work to be done to sort of make it all, aligned or similar or clean. So yeah, they're all different, coming in different shapes and sizes with different organizations. But the good news is once you clean it, you have it, right? And then on the go forward, you set up algorithms that are helping you clean it, right? And we now have, the vast majority of this data being piped directly into Maverick. And so it's coming in live. It's organized and kept in our data warehouse. And as we make improvements to it over time, it only becomes more accretive to the overall system.
Gotcha. That makes a lot of sense. And is that somebody's job, or how many people work on kind of your, if you think of a traditional real estate organization where you have acquisitions professionals and development professionals and asset managers and capital raisers, what does that operation look like from a, data and analytics perspective, the guts of what you're doing?
So today, that is the data strategy department. That is 3 employees at present at Maverick. And we're looking to hire one more. And they are sort of managing all of that information and data here in-house. Over the years, it started with Dave and I managing really bad Excel spreadsheets, throwing them out and starting over. At some point, we pivoted to I believe it was Microsoft Access. I don't even know if that product exists anymore, which is supposed to allow for more complicated or sophisticated spreadsheets. And then over time, we outsourced it to a series of partners who are, we realized we had sort of reached our limit in terms of managing and cleaning data. It's really complicated, and we were trying to build something bigger than of the moment. We wanted something that was lasting and working into the future. And so started working with a few third parties. But the past 18 months, there's been tremendous effort to bring it all in-house, as we see it really as our true competitive advantage here at Maverick.
So speaking of that competitive advantage, let's talk about capital raising. For a moment, as you think about how you position. Credit is extremely in vogue right now, and you've been doing it since it wasn't in vogue. But everybody has a new credit vehicle that they're bringing to market, and there's a lot of competition for the limited investor dollars that are available to be allocated in this market. And we don't need to go into the whole denominator effect. But when you're talking to investors today about credit, how are you, what's the sense? I mean, it's kind of always debated. Is it fixed income? Is it real estate? Where's the allocation sit? What are you seeing, from your investors? And then more broadly, as you talk to the market?
It's a great question. I just came from one of our pension fund investors' office, just sort of having an update meeting with them. Which was so great because we were able to be there in person with them and talk about it. And they had in the room at the table, I think it was 9 people, which was great and generous of them to give us all that much time and focus. But I tell you that because they had their real estate people there. They had their fixed income people there. They have like a bucket that's kind of more of like a special situations group there. And we actually asked them, like, should we be, and we've had a good relationship with these guys for a long time, should we be actively selling ourselves to a particular bucket? Everyone looks at Maverick Real Estate Partners and says, oh, real estate, right? Just because of our name, but the profile of our return, and the idiosyncratic nature of our return often suggests that it should be somewhere else. Now, this particular group has us in their fixed income group. We hear a lot of people putting us in their hedge fund bucket. We've got LPs that put us in their real estate bucket. And we're saying to this particular LP, like, is this something we should talk about? Should we care about it? And their feedback was every LP is going to be a little bit different in terms of how they think about you. Every LP is going to have a little more room or availability in a different bucket at a different time. We said, well, what are we going to stay in fixed income with you guys? What do you think? And they said, well, you're here, you're not moving. So that doesn't really answer your question. It's something that we've been thinking about for years, because even we've considered changing our name because we thought it might be a disadvantage. Yes, we have real estate at our base, but it's very hard to say what bucket we belong in for what group. And so, that was sort of the most sound advice I've heard, is stop worrying about it and just, make sure you're trying to talk to as many people as possible.
Yeah, I think that's fair advice. I think it also, from a GP's perspective, and I'm saying this, not you, it also is faced with the real constraint that there's only so many hours in the day that you can spend in, raising money versus investing money. And wouldn't it be nice if you knew where the money was coming from? But I guess the answer is, that's not knowable right now. And that's probably a byproduct of how the allocators are evolving their own thinking around real estate, which, a decade ago wasn't really part of the traditional kind of allocation. And it's been ratcheting up and up and up over the last, decade and a half or so. So I think it's interesting and understandable, but I think instructive.
Yeah, I think, look, in terms of our fundraising process, we've always done it internally. It's just been Dave and I. And truth be told, if you look at our investor base, which is about 80% institutional at this point in time, every one of them came through an introduction from a prior investor. And we're very grateful to our limited partners for doing that. They've interested to really high quality LPs. And I'm sure that there are some interesting conversations amongst those groups when they're talking about, well, what bucket do you have these guys in? Where do they belong? And how that works. And, I'm thankful for the introductions that we've had and the ability to do that.
What is the most common question you get from investors about your funds, given that you're probably needing to, respond to and address a very wide range of levels of sophistication? Some might understand fixed income really well, but not really fully grasp real estate. Some might be real estate experts, but are learning about credit. Like, what are some of the more common questions that you get asked?
It's interesting. One of the most common questions I would say historically that we receive is, can you scale this nationally? Because we've sort of proven this business model out, in New York City in such a successful way. And, certainly it's something that we've talked about inside here at Maverick. But, in our third fund, I think we were able to go out to New Jersey, Connecticut, and Pennsylvania, a little further afield from New York City, right? And that was a small fund. It was only $30 million. We sort of grew this really, really carefully and slowly. We just found those markets are so different. New York City has this information advantage. It has this, liquidity as far as real estate concerned. It's one of the most liquid real estate markets in the world, even today, even in the current environment. When you go to sell a property, multiple buyers will go non-contingent, all cash, quick close. You just don't see that anywhere else. You end up with a property in Connecticut, you might be at 20% of the value. It might take you a year to find the buyer, and meanwhile you're paying high taxes. The property's vacant, all sorts of carrying costs, and you're sort of in a terrible negotiating position. So, New York City's market is huge. Real estate credit is, prior to this, past 12 months, something like $130 billion of loans originated a year, right? It's tremendous. And so for a relatively small fund, $317 million compared to that scale of numbers, we're very happy to stay here in New York. That being said, at some point in 5 years, 10 years, long term, I don't know, as we perfect what we're doing here, it is intriguing to try to rebuild a model elsewhere. I would guess that those would be other dense cities where they have data and where the laws are similar, at least in some respects, to New York. So I would say that's like the most common question that we hear or have heard. At the end of our meeting today with the LP, they said, so why are you here? What are you selling to us? We said, it's an update call. And if some of these catalysts kick into gear and loan sales start happening quickly, or we get a bunch of these consensual type deals done, we'll burn through that relatively quickly. And given that some LPs are having their own challenges right now on the denominator effect and other things, we want to know, that the capital is out there when we're ready, and also give our LPs the time they need to act and respond. And so we have been hearing that a lot. When are you raising Fund 7, or what are you selling me here? But thought I'd throw that in there because I thought it was interesting.
Yeah, no, I think it is interesting, and there's a lot of planning that needs to take place from a portfolio allocation on the side of LPs in conjunction with their consultants if they have them. So that's a fair comment. Let's spend a minute talking about the New York City market. I mentioned it earlier. There's a ton of headlines that we all read about owner X or developer Y defaulting or giving back the keys. We hear the debate about return to office or not return to office, and who's winning. But as you sit there as a credit investor focused in New York City, how do you assess the fundamentals of what's happening right now, in the summer of 2023 on the ground? Or does it actually not matter for what you're doing? I mean, I imagine it matters. You don't want to be a long-term owner, but how do you think about, what would you tell somebody who's not in New York, who's reading all the same headlines that I read sitting in California about the New York market, as somebody who's only focused on that market?
Yeah, it's a good question. I think, a couple things to say about that. Number one, when we're sourcing these opportunities, we're not asset particular. We're not looking for a particular asset type. We're looking for, evidence of distress, places where we can get involved at a very low LTV, right? So at a significant discount to value, particularly in this type of uncertain market where the V is so uncertain. And so we start there and then work our way through it. That being said, just based on what we're seeing, we do have thoughts and ideas about what's happening within the market, and we are seeing it on our own investments in the portfolio, right? On the office side, are we coming back to office or not? I don't think that's a fully answerable question. I think things will change. I can tell you on the ground, I ride the train in every day from the suburbs, and it's getting busier, and it has been for 12 months. And there are more people here. When I got to my office this morning, and we're here right in Midtown near Grand Central, I had to wait in a line to get on my elevator. That hasn't happened since before COVID. That was a new one today. And so there is more action in terms of bodies on the ground. I'll also tell you that our lease is coming up on this office where we're at now, and we need bigger space. And so we've been out in the market looking at offices, and everyone says it. There's Class A, and then there's Class everything else, and that's kind of true. The Class A stuff is holding its own. It's occupied. We toured one Vanderbilt. It was an amazing building. They want $230 a square foot. It's a huge number. Other Class A stuff, that's like Class A plus. Other Class A stuff is sort of more in that like $90 a foot range. That gives you a little perspective that like the premium stuff is still doing really well. Class B and C, it's a huge question mark. That stuff, a lot of it's outdated. Some of it will probably get reused. Everyone loves to talk about converting it, to multifamily. You read all these articles about it, but there's a couple complications there. One that you read about a lot is, the floor plate doesn't work, or you have to cut off the back half of the building to make it work. Some of that's true, but you still end up with kind of like old stuff, low ceiling heights, bad windows, all sorts of things that possibly just mean you'd be better off just buying the land or demolishing the whole thing and starting over. But there's a whole political component there related to office around affordable housing. And that sort of takes you back to where we were with the signature stuff. And you have an asset that has a value challenge, and now you want to impose things on it that are going to create more value challenges, right? It's not really solving your problem. And it's not like building more housing is good. We have housing shortage in New York. That's true. But you have to have solutions that actually work. When they did the downtown New York City office rezoning, there wasn't an affordable component, and they converted quite a bit of that space to residential to housing. So, I think office space is fascinating. We don't have any in the portfolio at the moment. We've done a few here and there. You do see the big guys, the RXRs and the like, turning the keys in to their lenders, and it's scary. I think that value needs to reset. I think expectations need to reset. I still believe in New York. I think people are still going to want to work here. I think that's evidenced by what you're seeing on the multifamily side, where residential rents are through the roof. They continue to climb. And this is what the affordable housing, groups are worried about, right? And I understand that, because there's a whole segment of society that's really challenging for. But in terms of an asset class, it's doing really well. People want to be in New York. We hire a lot of young people right out of college. They're excited to be here and working in New York and be part of this, especially coming out of COVID. It's great to be back in the city and see it alive. On the hospitality front, that's a pretty interesting, environment. It's really a sort of supply side, story. There were some new regulations put in place in New York City almost 2 years ago that require you to get a special permit to build a hotel. And most everybody believes that the result of that special permit will be that you are obligated to use union labor to run that hotel after completion. Differing views on that, but mostly that it's more expensive. And most people don't think you can underwrite a hotel, ground up construction in New York City that's run union. And so, I think there's a lot of concerns around building new hotels. To put in perspective, since that regulation was put in place, there have been zero new permits pulled on hotels. So no hotels coming to the market anytime soon in New York City. In addition, a bunch of the stock has been demolished for a variety of reasons over the past few years. So a lot of keys have been taken offline. And now we also have, sort of this migrant housing crisis where we're putting the city signing deals with hotel owners to pay a guaranteed rate, 365 days a year, to house the migrant population that is coming to this city. And that's taking more keys offline. So on the hotel side, you're seeing this diminished supply, and that's driving ADR, through the roof. In talking to the brokerage community, that's a trend that they expect to keep climbing, over the next few years. It's also partially driven by, sort of increased, tourism, just people wanting to get back out and be in the city. Then you have industrial, and that's, there's it's short supply here in New York. It's doing really well. I'd expect that to continue. And then sort of what we have, which is really just sort of this credit side of the business. We think the supply of those opportunities will be ample for all the reasons we've talked about.
So, in closing, as we look at, the next, I was going to say 3 to 5 years, but I don't think we can look that far out. Maybe we'll look 3 to 6 months. What are some of the kind of, we talked about the Signature Bank portfolio coming to market, which will be, critical to hopefully unstick the market. What are some of the other leading indicators that you're focused on, whether it be the forward yield curve or like what are the data? What are you consuming right now to be prepared to strike when the opportunity presents itself?
Yeah, look, I think, from the day to day, our sourcing team is really using these sort of leading indicators of distress that we've developed over time. And they're on the phone with bankers and brokers and looking for sort of distressed opportunities that we can participate in. I'm looking for, banks and private lenders to start selling things at discounts. I think they have to trade at discounts. I think if we see that sort of start to happen, you're going to start to see things move. I think the sale of that signature portfolio is going to be really meaningful. I think that's going to be, hopefully by the end of this year that gets done. And I think once you see a trade of that scale, it's going to have a significant impact on this market. In the meantime, things are changing, every day. And we're sort of watching, everything, as closely as we can to try to be as informed as we can and really continue just sort of making, opportunistic investments from this sort of, credit protected position.
Awesome. I love that. Ted, a lot of our listeners often want to know how they can connect with guests on the show. What's the best way for people to reach out to you? Is it through the website, email, LinkedIn? What do you prefer?
Any which way is fine. You can go right through our website. There's sort of a general email address on there. Happy to connect with people on LinkedIn. Happy to meet with people and talk to people all the time. We're looking to learn. We're looking to collaborate and grow, and sort of very open minded in achieving all of those goals.
Awesome. Well, I really appreciate you joining me today to share some of your insights and perspective on what's happening in the market. I think we're at a really interesting time, an inflection point in our industry. And as you said, this time is similar yet very different with the rising interest rates to what we saw during the GFC. And I think the next, 3 to 12 months are going to be really interesting. And the opportunity here from you is super insightful, and I appreciate you sharing your insights. So thank you everybody for listening. Until next time.